Well, over 6 weeks after we saw some, uncertainty, war and a lot of fear in the market, all those fears have now been dissipated. You're watching us here on Trading Hour. We come to you live from the CNBC TV18 Motilal Oswal studio. I'm Mangalam Malu. With me, as always, Hormaz Patakia and Ritu Singh.
Yeah.
Today it's been, all the fear, uncertainty and bearishness was bottled up, and now it looks like someone just popped the can, and the market's got 900 points on the Nifty to show for, nearly 3,000 points on the Nifty Bank and the Sensex.
Yeah.
A lot of markets doing extremely well. It suddenly feels like the day the exams have ended and everyone's suddenly free. Isn't that?
Well, it's a 2-week pause, and let's hope it extends even longer. Let's hope this is, the end of the escalation of tensions in the Middle East. And you're seeing the market reaction. 18 stocks advancing almost for every one stock that is declining. So it's a good day. Oil prices are down all the way to 94. And we just heard from the RBI governor as well. No signs of hawkishness at all. And I think that is something the markets are going to take with both hands. Bond yields also coming down on the back of that. The rupee also recovering. Hormaz.
They could not have come at a better time. It's just 2 days away from the start of the earnings season, and that is also the big talking point that's going to be for the market going forward as well. Let's continue this conversation with Shreyas Devalkar of Axis Mutual Fund, who is joining in on the show. Also joining in is Anil Gupta of ICRA. Gentlemen, good morning. Thank you for joining in. Shreyas, to you first. Now, with this hope of a de-escalation and this hope that the next 2 weeks will bring about some concrete steps towards ending these hostilities over the last 6 weeks, now, do you believe that the opportune time for deployment of funds in the market was back when the markets were at extreme panic, or do you still believe that this is still a good time to deploy if you have a longer term time horizon?
Good morning, and thank you for having me on the show. Actually, as we always say, every time is the right time. However, obviously, 5 to 10% lower would have been better than the 5 to 10% higher. So the way we stand today is from the day this war started, the markets, at least Nifty is down 5%. At a point in time it was down 10%. So definitely that point in time would have been much better. But obviously the clarity on the outlook, it brings in obviously the higher prices and higher valuation to that extent. But if you look at it overall from the market point of view and overall market point of view, even at these prices, it's not that the 5% move is too big a move from the bottom what has happened as far as the headline index is concerned. If you look at multiple segments of the market, especially in the large cap, the valuation are reasonable. You take financial services, IT, there are real estate companies in the large caps. There are multiple sectors, including the consumer durables also, which failed a lot during this time. So multiple sectors have seen a lot of correction, including auto, no doubt on that. So because of this concern, so the combination of concern on the traditional businesses like IT, where the AI has been concerned, and the concern which was also driven by the crude underlying because of the war situation. And this combination has led to the reasonable valuation across the board, which generally don't happen many times. Only few pockets got elevated during this point in time, but otherwise the valuations are reasonable across the board.
Sure. Shreyash, do hold on. We also have Anil Gupta of ICRA who's joining us on the show. In a short while, we'll also have Lata with us. But Anil, first, on these two capital adequacy measures from the RBI, if you could explain to our viewers what it means. One, to remove the condition regarding NPA provision inclusion in quarterly profit for capital adequacy computation. That is one. The second is the removal of the Investment Fluctuation Reserve. How much incremental buffer, how much relief does this give to banks?
Yeah, hi, good morning. Thank you for having me on the show. The quarterly profit inclusion of the banks, let's say when we look at the quarterly profit reporting in maybe the statutory reporting which we see on the exchanges, generally those capital ratios don't include the quarterly profits, and hence when we see the full year audited numbers, especially for the PSU banks, there is a sharp jump in terms of reported capital ratios because the full year number is an audited number and audited profits can be included. So what we will now see is maybe between let's say Q4 of a financial year, let's say we end in March 2026, till March 2027 there will be a decline in the capital ratio because of the consumption and not inclusion of the profits. for the quarter. Now what we will see is possibly a improved capital ratio, not a steep jump between December to March reporting in terms of capital ratio. So that is basically the change which is related to the NPA provisioning, because let's say if your NPA provisioning, there is a lot of volatility. What happens is RBI says don't include your interim profits in your capital ratios. But now you can include your quarterly profits into your capital reporting. On the second change, which is talking about the doing away with the investment fluctuation reserve.
Yeah.
So this investment fluctuation reserve was introduced somewhere, I think in 2018, and banks were required to build investment fluctuation reserve through their P&L account at around maybe 2% of the AFS books. Now this 2% was created over a period of maybe 2 to 3 years when the bond yields were favorable, and this was included in the tier 2 capital of the banks. Now, subsequent to the changes in the investment guidelines in April 2024, RBI allowed a creation of AFS reserve, where basically your unrealized gains could be included in the AFS reserve, which boosted the capital of the banks, and this was included in your CET1 core capital ratio.
Yeah.
Now, because of these recent bond yield rise, the core capital ratio will get adversely impacted because the AFS reserve is likely to go down. So now what happens is the IFR, which is investment fluctuation reserve, which is no longer required, can be included in your tier 1 capital. So what we will net basis, what we will see is that the tier 2 capital ratio will possibly go down, overall CRAR will go down, but the CET will get a boost, the core equity capital ratio will get a boost because of inclusion of the IFR reserve which the banks are carrying.
Got it. Okay, let me also quickly invite Lata Venkatesh, who's joining us now from RBI. Lata, you had a question for Anil as well.
No, not question. I got answers from the banks, and that's what I'm going to share with you. What the bankers said is that they were not allowed to include their quarterly profits in the capital, as Anil said, because what if next quarter your NPAs go up? Then you will need more for provisioning. So they were allowed to do it only at the end of the year, especially if there was a wide fluctuation in their NPA. Now, even if the NPA fluctuates, they are going to be allowed to include their profit. So it's a capital gain. Likewise, the inflation fluctuation reserve going away also improves your tier 1 capital. But this banker told me that that doesn't mean anything immediately, because almost all banks are sitting at very healthy capital adequacy. It's not as if you're sitting at a capital adequacy of 12 or 13%, and because you don't have enough capital, you're not able to give loans. It's not like that. They're all sitting at 15, 16% capital adequacy, and if that 16 goes to 16.2, it's not as if they're going to give more loans. And hence, any immediate impact on the P&L because of a higher loan growth is not on the cards. It is just a comfort zone that I am not rushing to raise capital anytime soon. There is a little bit of 20 basis, 30 basis of extra capital that has been released for banks because of these two provisions. A third point which we perhaps did not make much of, the NBFCs now can participate in the money market. So the call rate market, which until now was only a few banks, and therefore the volume was much lower than the tripartite repo market or the CBLO market, now you can have non-banks participating. This could be an advantage to the NBFCs, because for a day, if they want liquidity, that liquidity is also available from the call market, which could be a bit of an advantage. What the NBFCs really want is that we should be allowed to access the repo window. That is not said over here. We of course have to wait for the instruction, because what we have is only the governor's speech. But if they are allowed to access repo, then NBFC stocks will go through the roof. That is not on the cards. They have been only allowed to participate in the call market, and that means a little more money for them, a little more intraday flexibility. I thought I should put that on the table. Anil, you want to add on this?
So I think you correctly said that the volumes in the TREPS markets were multifold compared to the term money market, and I think wider participation will not only improve the rates at which the money was available from in term money market, but also maybe improve the liquidity of the participants because the rates are definitely better in the term money market than the overnight market.
James, the financials doing extremely well, but just to put things into perspective, ever since the war started, that period, the Nifty was down almost 12.5%, and the Nifty Bank was down 17.5%. So it was a bigger underperformer, and now it's, unwinding, and it is becoming a bigger outperformer. So all of this will be very interesting to see how the IT stocks are panning out, because the IT index is underperforming today. Remember when the war started, from then to now, the IT index was absolutely flat, even as we saw the Nifty fall about 12% and the Nifty Bank down about 17%. Thank you, Anil, for joining in. Let's go back to Shreyas. Shreyas, how does your portfolio stance move from here? Obviously, the war period was that of uncertainty and capital protection was sought. Now, do you think you will shift focus back to taking some aggressive bets that you were holding on to while this uncertainty was on? Or maybe your approach continues the way it was, whether or not there was any sort of geopolitical development?
Obviously, yes, we were taking some aggressive bets, especially in Jan, Feb, March, in the sectors, in auto, especially in the CV space, and probably with this development, there were question marks around this. I would not say that yes, everything goes back to normal, because certain things one need to keep in mind that where the crude settles eventually, and how it overall impact. Because end of the day, if this supply constraint led inflation remains for some time, then there is going to be some impact on demand as well as margin. So if you see even this quarterly results and the previews which have started coming in, there was only few maybe weeks of impact on some of the companies. But yes, there has been impact of this. So unless we say that yes, things go back to normalcy, crude prices back to $70, then definitely we will be more aggressive on those bets. However, having said that, because of these developments, I would not have changed much the stance, because anyway it was expected that this is going to be transitory. Whether it is 1 month or 3 months, that was always debate. Even today we can call out that yes, it is back to 70, it is still 95.
All right, Shreyas, Anil, thank you so much for sparing time and joining us today with your views on the markets, and of course a lot of these policy announcements made by the Reserve Bank of India. 24,000 back on the index for the first time after the 10th of March. So almost a 900-point gain now on the Nifty, back above the mark of 24,000, and that is of course led by the Nifty Bank. Take a short break. The management of Amul joins in on the other side as they've hit the 1 lakh crore rupee top line milestone. Discuss the outlook going ahead with the Managing Director, Jayant Mehta.